walk us through that really cool map and show us where the danger spots are?
Well, yeah, I'd walk you through Texas, North Dakota, a few places with higher, actually Texas I think is not contracting, but it's really the places where you have higher energy sector exposure. Where
so North Dakota and Wyoming basically right now.
Yeah, basically. So we don't have broad economic weakness in the United States at all. We have mining sector, railroad sector, energy sector weakness. We have modest weakness in manufacturing, but even manufacturing is not contracting.
So I know a lot of people have been comparing this to 1980 oil crash, where we saw similar regional weakness in the economy, but overall the economy didn't go into a recession. Does that look like a proper parallel to you?
It does, yeah. That was in 1986 when oil prices fell very sharply. It actually, we had regional recessions that kind of rolled through the economy for a few years. And you did have some losses in the banking system related to that. So it was a real event. It just wasn't sufficient to cause the whole economy to start to fall.
And that's kind of what we're looking at right there. So at the far left-hand corner, that little dip, that's sort of what happened in the last oil crash.
That's right. And those states that fell were precisely the ones that were the energy-centric states, Oklahoma, Texas, et cetera.
What would you want to see for you to change your mind? Is there data that would say, okay, this is actually spilling over and greater than I thought it was?
Well, I mean, the labor market is a coincident or slightly lagging indicator. But really, to get into recession, you need all sectors to get a little bit more risk averse, and people pull back on investment and hiring plans across the board. Really not what we're seeing. And you know, the labor report was just out on Friday, and it actually looks pretty good with some very strong income numbers for households.
Deutsche Bank continues to have the thesis that the weak productivity we've seen is actually due to weak demand. And if we don't see demand really pick up, the companies that have been hiring are going to have to fire because they're just not going to be able to or need to make the products. What do you think about that?
Well, it's hard to really call it weak demand when consumption's been running in the high twos recently. So we've had very strong consumption growth. Business investment is kind of a mixed picture. But construction is growing strongly. I think there are some longer-term drags on productivity that matter a little more. So I wouldn't have exactly that view. But I think the issue right now is with risk aversion on the rise and with concentrated stress happening in energy, is this going to create real losses, clog up our credit system, and spook people to the point that they cut back on hiring and investment where they otherwise should not?
There's one common argument or one school of thought, which is that historically recessions are caused by the Fed. So ultimately the Fed tightens to the point that slows the economy. Where are we, at what point, how much further can the Fed tighten without that happening again?
Well, I mean, the market has voted and decided that the Fed won't be tightening for some time. I don't really agree with the market at this point, but I don't know, maybe
When you say you don't agree, do you mean you think the Fed will hike more times or that the Fed can hike more times?
I think the Fed will hike in 2016.
How many times are you thinking?
Up to 3 times.
Okay.
And that's basically a second half recovery. I mean, remember, the unemployment rate just fell below 5%. Core inflation is drifting higher and wages are beginning to accelerate. So, it's early February. We're in a risk appetite panic. And, it's important not to just extrapolate this through the year. But actually, I think the recession risks may be rising nicely for 2017, because by then we could have a much lower unemployment rate, we could have faster wage growth, and you could get to the point where the Fed is actually, needs to hike even if global growth stays fragile and if credit growth stays fragile. Credit is a long-lived lead indicator for what happens. So just because credit is seizing up now doesn't mean we instantly go in recession. It could be a year from now. In 08, it was a lot earlier. The stress in credit markets preceded the actual severe economic stress by many months.